Now we're going to be moving on to chapter 10.1. Okay, so we are moving away from chapter 10 is going to be dealing with receivables and what happens when you need to deal with bad debt. Okay, so again, let's go talk about what a receivable is. So, well, what is a receivable? Okay, from what we understand, a receivable is it's pretty much another form of currency that when we sell a good or a product or service, right, and we allow our customers to pay us later, then we are creating an accounts receivable. Okay, straightforward. And it's just like I said, it's another form of cash. Okay, again, it is what other people owe you in return for the product and service. So again, what that entails is us collecting information from our customers in order for us to properly create an account for them to let us know what they owe us and what products they have purchased from us. Okay? So ultimately, a receivable is, in other words, another current asset. Now, what I'm going to be introducing to you is called the allowance for doubtful accounts. Now, what happens is if you understand that you are going to have your customers owe you money, you also have to remember that if you do let them owe you money, you have to understand that there is a risk to that, because there will be customers that tell you, hey, I can't afford to pay this bill. I lost my job. I can't pay you back. I filed for bankruptcy. I can't pay you back. Or straight up, I don't like you, so I'm not going to pay you back. So what that means is you're creating a debt, okay? Because you sold them a product in hopes of receiving money, but because, you can't trust all your customers to make sure that they pay on time, so therefore you're going to create bad debt. And how we're going to be able to do this. So again, when people file for bankruptcy, right? Or people who just don't have enough money again, right? Or they just can't pay their credit cards off. Okay, those usually would signify that you do need to create an allowance. Okay, now what an allowance does is for the money that you owe them, so it's taking a receivable and you're going to transfer into a temporary account, which is called allowance for doubtful accounts, to place it in hold for if and when they do actually pay us back. Okay, so what allowance for doubtful accounts? It is a contra account. Okay, it's a contra account that's going to reduce accounts receivable. So in this case, by understanding it's a contra account to accounts receivable, so therefore it should have a credit balance. Okay. Now, when we're dealing with when we're dealing with allowance for doubtful accounts, there are three things that you're going to know. You're going to definitely know who is going to be owing you. Okay, it's going to be whoever's that owes you the money. They're going to report to you that they don't know, they can't afford it, they can't pay you back. So therefore, you know who is the person that's going to be faulting on their payments, and you're going to know the exact amount, because if you have an account with them, then you should also be keeping track of how much they owe you. Okay, and then lastly, you know exactly when, because they're going to give you the phone call and say, I can't pay, or a debt creditor is going to call you up and let you know that this person, which is your customer, has done this, so they can no longer pay you. So you know those three factors. You know who, you know how much they can't pay you back for, and you know when it happens. Okay? So, for example, on December 16th, Mr. Sanchez has bought $100 worth of toys from your company on account. Okay? He pays $20 every month, starting in January. Okay, and then on March 20th, he files for bankruptcy and lets you know that he can no longer pay you anymore. Okay, so understanding that concept right there, we created an account for Mr. Sanchez. He owes us $100. He makes us promises that he's going to pay us slowly by, doing a payment plan, $20 a month. Now, 2 months later, he decides to file for bankruptcy. So now we need to keep track of how much he made the payments for and how much he actually owes us left on account. So this is where we're going to use our accounts for allowance for doubtful accounts, and we're going to recognize here in March that he can no longer pay us. So we initially started with a December 14th saying that our accounts receivable is now $100 and that we sold toys to him for $100. And here, with other journalizations and stuff, we've already journalized January payment and we journalized February payment, just to make it here that on May 30th, he still owes us $80. Oh, I'm sorry, he owes us $60 because he made $20 payments. So he's paid us $40 already. But because in March, he tells us he filed bankruptcy, he can't pay us anymore. Therefore, he still owes us on account $60. Okay? So, the reason why we use allowance for doubtful accounts is, what do we know? We know who, so Mr. Sanchez. We know how much, which is the $60, and we know when it happened, which is on March 20th. He reported to us that he can't pay us. So this is where we take our allowance for doubtful accounts, and we're going to debit it, and we're going to credit our accounts receivable. Okay?
Okay.
All right. So, again, the reason why we keep it in our accounts receivable is because we still have a possibility that Mr. Sanchez might turn around and say, hey, I can pay you back now. Okay? But again, you only do this if you have a for sure guarantee that he is not going to pay you back. Okay? So after, let's say he does tell you that he files bankruptcy and you're still after his money, or for any reason, maybe he tells you, I don't like you, I don't want to pay you. You're going to have your debt collectors ready to go collect the money from him. You're going to send him statements. You're going to give him phone calls. You're going to basically ask him until he pays you back. Until he gives you the definite answer saying, I filed for bankruptcy. There's possibly no chance I'm going to pay you back unless you're going to wait for 7 years. Then that's where you can determine to go ahead and place it into the allowance for doubtful accounts. Okay? Does this make sense? Okay?
Yes.
He owes us money and he tells us he can't pay it. So therefore, we need to separate that because we know that this money will never come to us. Okay? So we need to put it in a separate account. Now we're going to be introducing a little new segment called Bad Debt Expense. So here we're understanding bad debt expense, right? We need to write it off our books because if we keep having our assets say that we have this amount of money, it's going to look bad on our reports because we know that we're never going to collect that money. So by us overstating our assets saying we're supposed to be receiving all this money, when in reality you're not getting that money, you're creating a hole in your company. You're creating fake profits that isn't realistic, that isn't real, because you're never going to collect that debt. So what you need to do is at the end of the period, you're going to create a bad debt expense account. Okay? Let me say that again. At the end of the period, you are going to create a bad debt expense account. So that makes a bad debt expense account an adjustment entry. Okay, adjustments happen at the end of the period. Okay, and here what this bad debt is going to consist of is it is actually an estimated amount. Okay, because in reality, if I have 20 people owing me money, how realistically am I going to trust all 20 people that they're going to pay me on time? In the perfect world, yes, you're going to trust that all of your customers are going to pay you. But if, again, because you're making the assumption that you're allowing your customers to owe you money, therefore you need to accept that there is a risk that you have those people that can fault on you. So what you're going to do, you're going to recognize is that this estimated amount of number is going to be a future loss. Okay, you're predicting that in the future you're realistically not gonna collect all of your accounts receivable. Okay? So with that, you're gonna make an assumption. So you're not gonna know who is going to not pay, right? It's an estimated number, right? If all 5 of you owe me on an accounts receivable, I can make the assumption that, I don't know, 10% or 5% of those people, so whether if you are included, you're not going to pay me back. Do I know that David's not going to pay me back? No. Do I know that Andrea's going to pay me back? No. So this is why I create an estimated amount, so I will not know who. Do I know how much? No, I don't know how much. David can call me and say, I'm not going to pay you for $100. But I will not know at the end of the period. So that's why I will not know how much. And lastly, I do not know when. Okay? You can never predict people's lives, okay? Unless you're living and breathing their life, then you are not going to know when, you're never going to know when they may file for bankruptcy, right? You never know when. So those 3 things that we're looking at here is, in terms, it's going to be opposite of the allowance for doubtful accounts. Allowance for doubtful accounts, we know who, we know when, and we know how much, correct? Bad debt expense, we don't know any of those 3. Okay? Allowance for doubtful accounts is a contra account. Bad debt expense is an adjustment entry. Okay? So understanding the difference between that. Okay, so when we do the allowance for doubtful accounts, it happens during the period, right? Where our bad debt, we don't recognize it until the end of the period, and you've exhausted all your capabilities to try to collect the debt. Okay, so what I'm going to be introducing you is the method for bad debt expense. So we're going to put allowance for doubtful accounts on hold for a second, and we're going to focus on how to recognize bad debt expense. Okay, so there are 2 methods that you need to know. The first method is going to be the direct write-off method, and the second method is going to be the allowance method. Okay, now there is a difference between the 2, and how we are perceiving it will be determining which one you're going to be using. The direct write-off method is only for tax purposes only, okay? For tax accountants, you're going to be dealing with what you can claim as a loss. So when you apply it for tax to get either a tax write-off, that is what you're going to be doing. And this is us. You're going to directly take it out of accounts receivable straight off the bat. Okay? So if you look here in the example below, you're going to create your bad debt expense and you're going to write it directly off of your accounts receivable. Okay? So that is called the direct write-off. Again, this is for tax purposes only. And unfortunately, tax accountants are the only ones that's able to do this. For the purpose of our class, are we the tax accountants? No. We are just the regular accountant. So therefore, we need to follow the allowance method. And what the allowance method is, it's governed by the GAAP, which is the generally accepted accounting principles. They tell you if you're not the tax accountant, you need to write off your bad debt expense as an allowance. Okay? So what you need to do here is, for accountants, you're going to recognize when you see that this person is not paying you, you're not going to write it off as a bad debt expense. In fact, you're going to create an allowance for doubtful accounts. And when you're for sure that these people are not going to pay, you're going to, the journal entry is going to be bad debt expense and allowance for doubtful accounts. Okay, so under the allowance method, you're going to recognize two different ways, and I'm going to go ahead and show you both ways. So balance sheet method and income statement method. Okay, so again, for the sake of this class, you will know what the direct method is, but you are not going to be doing the direct method. Okay, all you're going to be doing is the allowance method. Okay, and here is what the balance sheet method should look like. Now, again, you're going to be recognizing bad debt expense. And instead of writing it directly off of the accounts receivable, you're going to create your contra account for allowance for doubtful accounts. Okay? All right?
Okay.
So now that we recognize the accounts, now if you're doing the balance sheet method, the balance sheet is going to allow you to see your accounts receivable, okay? It's going to allow you to see the allowance for doubtful accounts, right? When we do our balance sheet, it's a list of all of our accounts, and accounts receivable is one of those things that is listed, okay? When we are doing the balance sheet method, all I need you to recognize is, if you look at the box up in the right corner, is you need to understand, you need to recognize what the estimated amount is. Second of all, you're going to seek out the word accounts receivable. If you see the word accounts receivable, the next step that you need to recognize is, do you have a balance in the allowance for doubtful accounts? And if you do, what is it? If it's a debit, you're going to add. If it's a credit, you're going to subtract. Okay? Now I'm going to show you this example carefully. Okay? So you guys can ease this way in. So the scenario goes, the example number 1, it is estimated that $25,000 of a $500,000 accounts receivables is uncollectible. Okay? There is currently a debit balance of $5,000 in the allowance for doubtful accounts. Journalize this adjustment. So what we're going to be doing is we're going to be recognizing what is the estimated number. In this scenario, it says it right here. The estimated amount is $25,000 out of $500,000. Okay? So your estimated amount is going to be $25. Okay? Now the next word is you see here is going to be accounts receivable. We recognize here, if you see accounts receivable, the next step is, what is the balance in the allowance for doubtful accounts? Here it tells you you have a debit balance in your allowance for doubtful accounts, and it's for $500. So what that means is you're going to add $25,000 to the $5,000, and you're going to get a total of $30,000. Okay? Now, you're probably thinking, hold up. Why are we adding these numbers? What are we doing here? Okay? It will make sense when we go ahead and move on to the exercises. So, where this allowance for doubtful accounts comes from is from when we had a person say, I can't pay this. So, for example, Mr. Sanchez, right? He owes us $60, right? So that is contribute, and what we know here is we have a debit balance in our allowance for our doubtful accounts for that $60. So this is where we get this number, this debit balance from. Okay, we recognize that this person owed us money. Now he can't pay us. So this is my total amount that I've accumulated through this entire period. So this is including not just Mr. Sanchez, this can include everyone that owes me money that has already told me I can't pay you. Okay, so that is why we have a debit balance in the allowance for doubtful accounts. And what we do is we're recognizing it here. Okay, we recognize that on the balance sheet, you're going to have your allowance for doubtful accounts, and you're also going to have your accounts receivable in that same sheet. Okay, so you're going to be recognizing those amounts. Now, how we recognize it, the bad debt, is we're making an estimate that out of those $25,000, out of the $500,000, 25,000 of it is going to be uncollectible. As in, I don't know who, but I know for sure that I'm not going to be able to collect that $25,000. And because I know that I for surely have $5,000 that people owed me and told me that they're not going to pay me back, I need to add that into my actual amount that I'm estimating. Okay? So here, therefore, I have a total of $30,000. Okay? Does this make any sense?
Yeah. Yes, the way you explained it, you had the everything up in the count.
Yes. Okay. So here, this is a easy little what do you call it? Trick for you to be able to answer these questions is if you can recognize the estimated number, if you can recognize the terminology accounts receivable, and to recognize is there a debit balance or a credit balance in the allowance for doubtful accounts, then you should be able to answer this easy. Okay? So again, next exercise here. Okay, so I have the same scenario, but this time my example is I estimated $25,000 of my $500,000 accounts receivable is uncollectible. There is currently a credit balance of $5,000 in my allowance for doubtful accounts. How do I journalize this?
Yes, subtract the 25 from the 5,000 from 25,000.
Good. And what do you get?
20.
Yes. So you're going to get $20,000. Okay. So what this $5,000 credit is, right? Someone is attempting to pay. Okay. But you know for sure that this money right here is someone's attempting to pay. So you went ahead and credit the accounts back, right? So you reverse the transaction, allowing you to have a credit balance in your allowance for doubtful accounts. One thing you know that if allowance for doubtful accounts has a credit balance, right? Because it's a contra account, right? It flows in the opposite direction. So you know that the allowance for doubtful accounts has a credit balance. Because these $5,000, there is people that we know that they for surely are going to pay us back. Therefore, we know that out of the $25,000, at least we guarantee that $5,000 is going to come back to us. So therefore, if we recalculate it, we only know that 20,000 of those people is realistically not going to pay us back. Okay? So we adjust our entry, adjust our amount of bad debt expense that we're writing off because we know that 5,000 of those money is going to potentially be paid back. Okay? So here,
Yes.
yes, so by following the guidelines here, we recognize that at 25,000 is our estimate, and we recognize that it's a credit balance. So therefore, we need to subtract the two numbers, and we get $20,000. Okay? Any questions about this? Okay? So next thing that we're going to be doing is we're going to looking at the second method of the allowance method, okay? So you can choose either or to utilize, okay? There is no right or wrong, but the only thing is if you choose one, you must stay with that. You cannot do the other, okay? You cannot do two bad debt expenses, one for one for balance and one for income statement. You need to choose one. But however, you can have the the variety and the freedom to choose either or. Now, what the income statement does is, so on the income statement, it basically recognizes two things: your total sales and your total expenses. Okay? When we move on to actually looking at each statement, you're gonna notice that you will never ever see the word accounts receivable in your income statement. Okay, your income statement again only consists of all your total sales and your revenues and all of your expenses. So that's why we named this the income statement method, is because instead of looking at accounts receivable, you're going to be looking at a new terminology called total credit sales. Okay? And when we recognize total credit sales, we don't care if there's a debit balance or a credit balance in the allowance for doubtful accounts. Okay? So let's look at the top corner. So in order to be able to journalize the income statement method, you're only looking for two things. You're going to be looking for the estimated number, and if you see total credit sales, that's it. You're just going to take the estimated number, and that is what you're going to be journalizing. So for this example, it is estimated that $25,000 of a $500,000 total credit sales is going to be uncollectible. Okay, you currently have a debit balance of $5,000 in your allowance for doubtful accounts. Journalize this adjustment. So here we're going to recognize the same accounts are going to apply. You're going to recognize your bad debt expense. Okay, and you're going to credit your allowance for doubtful accounts. Okay, so with the rules I have already spoken to you, how do you journalize this scenario?
I want to minus the 5,000. I want to minus the 5,000 and from the 25,000.
Okay, but again, I just went over this. When we recognize the word total credit sales, do we even care about what is in our allowance for doubtful accounts?
No.
No. So if we don't care about anything that's in our allowance for doubtful accounts, therefore, what are we actually caring for?
5,000? No.
5,000 is your balance in your allowance for doubtful accounts. We don't care for that.
You estimated 25,000.
Yes. You're only going to recognize the $25,000, and that's what you're going to journalize. Okay? All right.
Okay.
Do you understand the difference between this. So, again, the difference is you're recognizing total credit sales. Okay? If you only see total credit sales, because, again, on the income statement, all you will be seeing is your total sales, your total revenues, and your total expenses. Now, if we know allowance for doubtful accounts is a contra account to accounts receivable, is accounts receivable going to be on the income statement?
No.
No. Same thing for the allowance for doubtful accounts. If allowance for doubtful accounts is a contra account, will you see allowance for doubtful accounts on your income statement?
Yes.
No, David, no. Is allowance for doubtful accounts a part of your sales?
No.
No, it's not.
No, it's not. It is a part of your accounts receivable. So in this case, we do not care or have any association with the allowance for doubtful accounts. Okay? This one is probably the straightforward one. Okay? So let's practice what we just talked about. Okay? So in scenario 2, the estimated amount of $25,000 out of the $500,000 total credit sales is uncollectible. You currently have a credit balance of $5,000 in your allowance for doubtful accounts. Journalize this transaction.
25,000. You don't care about the credit balance in the account.
Okay, so what number are we going to be using?
25,000.
Good. Because the key term here is total credit sales. If you recognize that, therefore you don't care about what's in your allowance for doubtful accounts. You're going to go ahead and take the estimated amount, and which is $25,000. Okay? Is this clear? Do you understand?
It's sinking in.
Yes, no.
Okay? So, chapter 10 review again. We're going to recognize that when we allow our customers to have accounts and owe us money, here we're going to be creating a receivable. For any reason that they can't pay us during the year, we're going to recognize that it's going to be an allowance for doubtful accounts, right? It's a temporary account that we're going to take the amount that we know that this person owes us, and we're just going to place it into the account, the allowance for doubtful accounts. Okay? Whereas once we've exhausted our total amounts and we know for sure that this person is not going to pay us back, that's when we can go ahead and create our bad debt expense. And we're going to recognize bad debt expense, and it's going to include, depending on which one it is, it's going to include our allowance for doubtful accounts. Okay?
Okay.
So the difference between the two, again, allowance for doubtful accounts is going to happen during the period, and you know who, you know how much, and you know when. Okay? Bad debt expense is going to happen at the end of the period, so that's going to be an adjustment entry, and you do not know who, you do not know how much, and you do not know when. Okay? Because it's an estimated number. Okay? And then the difference between it when we're dealing with bad debt and journalizing it, okay, we need to recognize that which ones are we going to be using. We're definitely not going to be using the direct write-off method because that's for tax accountants. It's for tax purposes. We, by GAAP, we have to follow the allowance method, which in this case there are two. You can either choose the balance sheet method, or the income statement method. Okay? Again, the balance sheet method is going to consist of you understanding what the estimate is, the term accounts receivable, and you're going to actually care about what is your balance in your allowance for doubtful accounts. Do you have a debit balance or do you have a credit balance? If you have a debit balance, you're going to add the two numbers together. If you have a credit balance, you're going to subtract those two numbers. Okay? Whereas if you're dealing with the income statement, you're only dealing with total credit sales. And when you recognize the word total credit sales, you don't care about whatever's in your allowance for doubtful accounts because the income statement doesn't have the allowance for doubtful accounts. It only focuses on your total sales. So from there, you're only going to focus on the estimated amount of number. Okay?
So that one's easier.
Yes and no. Okay? And then lastly, how to journalize it. So again, for both methods, you are going to recognize your bad debt expense and you're going to credit your allowance for doubtful accounts. Okay?
Okay.
All right. So let's go ahead and move on to chapter. So let's go ahead and do this. So here I have uploaded for you. It's going to be the allowance method sheet exercise, whatever it is. Okay? So for example, I'm going to go ahead and say on December 15th, Robert buys a total of 100 coffee mugs at $9.99 each on account. Sales tax is 8.375%. So let's go ahead and journalize this. Okay? So what happened? Yes, December 15th.
100 coffee cups at $9.99 each, and sales tax at 8.375. Okay, wait a minute, I did that wrong. So you got
82.4175.
Okay. Okay, what is the rule, number one rule, before determining the number? What do you need to determine first?
Accounts.
Yes. Okay. We need to determine our accounts before we can determine our numbers. Okay, so what is the first thing we're going to recognize?
okay, it's gonna be inventory or coffee cups, mugs.
Yeah,
What are we
mugs.
doing? What is the transaction on hand?
Okay, accounts receivable.
Yes. What is the transaction on hand? What did we do?
We
bought,
sold,
100 mugs.
Okay.
we sold. Okay, this is a sale,
Mm-hmm.
receivable.
Oh, right, he bought it, we're not, yeah,
We're not making a purchase. No, we are.
right.
This is someone
Right.
we're selling. So therefore, yes, accounts receivable is going to be the first one because Mr. Robert here is going to owe us money. Okay? Now, what is our credit going to be?
Sales and sales tax receivable.
Yes,
payable.
sales tax repayable. Yes. Okay? Good. Now we can determine how much of each that we are actually calculating for. So if you bought 100 mugs at $9.99, what is their total sales?
$999.
$990.
Nine.
Wait, hold on. Okay, so it's $999. And
Right.
how much?
83.
Sales tax is $83.62.
Sales tax is
83.67.
I got that. Yeah, I got 83.67. Remember, it's not 8.25 anymore. It's 8.375.
Right,
Okay, make sure that you read carefully, okay? So it is $83.67.
62, 67.
Okay, and when we calculate this, what is the total amount that he actually owes us?
1,082.60.
Hold on, too many people talked at once. What was it? 1,000. 182, 1,082. Oops, sorry. 67. Good. Oopsies. 67 cents. Okay. So this is what Robert owes us on account right here. Okay. Okay. So on January 15th, Robert sends a check for $25. Okay.
Yeah, okay.
Okay. So what do we do?
15 January.
15 January. Okay.
Um, accounts payable
Okay. Good.
and checking.
Yes. No.
No, I had yes. I like that better. Yes.
Okay. Let's look at this carefully. Okay. Robert
Okay.
is paying us money.
Yes.
So,
Accounts receivable.
Accounts
yes,
receivable.
accounts receivable. Yes. But what are we receiving?
A
Receiving a
Check.
check. So we're going to automatically deposit that in our checking. Okay. And what does he owe us? So let me make sure What does he owe us?
Not enough, but no, he put down 25.
Yes, so we need to reduce the amount that he owes us with that $25, right? Okay, so accounts receivable. Okay, so here I'm going to, he wrote me a check for $25 and I'm going to journalize that. So that means he doesn't owe me $1,082 anymore. He owes me 1,000, whatever 82 subtract 25 is.
Yeah.
Okay, so subtract 25. So he now owes me $1,057.67. Okay. Okay. Then on February 15th, Robert informs us that he can no longer pay for the he can no longer pay for the cups due to financial circumstances. Okay? We do not know what happened, but do we know what happened?
No.
No, but
Yeah, he can't
we
pay.
know that he can't pay. So what are we going to recognize here?
Yeah. The date, who, and how much.
Okay? How much does he owe us? We just calculated earlier.
Total
1,000,
balance,
57.
Yes.
1,057.
Yes. 10,057. No, I think it's 52.67.
57.
Oh, yeah, you're right. 57.67. Okay? We know that much so far. Okay? Now, if we know he's not going to pay us, okay? What accounts are we going to be using?
Bad debt.
Not bad debt. We're not at the end of the period yet.
This is during the period, so it's got to be that allowance. Well, it's an allowance method.
Yes, you had it right. We need to create a contra account, right? A separate account to for us to recognize that this is potential money that is not going to be coming back to us. So allowance
Correct.
for doubtful accounts. So I'm going to go ahead and put ACCT, okay? Now that we know that this money is coming out, we've created a contra account. Where are we taking this money out of?
Receivable.
Say that again.
Accounts receivable.
Accounts receivable is correct because we need a place to transfer the money that he owes us, right? And if he owes us on accounts receivable, we need to take it out of our accounts receivable because we no longer need to calculate that we're going to be receiving this money from him. We already know that it's a potential that we might not ever receive it to him. Okay?
Yes.
All right. So now we have zero balance in our accounts receivable, and we have a debit balance of $1,057.67 in our allowance for doubtful accounts. Okay.
Yes.
So now we're going to look here on number 4. On June 15th, Robert says he can pay $25 this month and sends a check. Okay. Okay, now he says 6 months later, you know what? I have some spare cash. I'm going to go ahead and pay you.
Okay, so
Okay.
checking, $25.
Hold up. What do you need to do first before you recognize that?
Date.
Okay, second thing.
Um, you know who, you know how much,
Okay,
and you know why,
okay.
right?
Yes and no.
Uh,
Before we can even
Yeah.
recognize his check, right?
Let's make sure it's good.
No.
No, you have to move the money back into account.
We need to put the money back into the accounts receivable. Okay? So we need to reactivate his account. So how do we reverse a transaction?
So we just, he's paying us $25 more?
Yes.
Yes.
Okay, so we do accounts receivable for $25.
Okay.
It
And
is
allowance
accounts
for
receivable,
doubtful.
but it's gonna be for 1,057.
Yes. 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 Okay, accounts.
Oh, for the 1,057.
Because
Yeah, for the whole receivable.
yes, the reason why we have to do it that way is because we can't just say, oh, I'm only going to, if he's paying us back, we need to activate his entire account. We can't just take that one small section and say, well, he paid for $25 of it. No, we have to make the assumption that, yes, he is potentially going to pay us and we might have a possibility of collecting the entire amount. So here we need to reverse our transaction. So here we're going to recognize, we're reversing the transaction. So we are reversing, so allowance for, I'm just going to do doubtful, okay? That I can't finish the rare. Okay, so now that we understand this, we're reversing the transaction for 1057.67. Okay, so we are allowing him to make the payments, and we have a possibility to collect the rest of the money. Okay, and then here, then now I can recognize that he paid for this amount. So, because we are receiving a check, we're going to reduce the accounts receivable under his name, okay, for the $25. Okay, so now he owes us $125. I'm gonna say 132. Sorry, 1032. 67.
67.
Okay. Okay. Good. Then on July 15th, so let me see, when was this? June. So the next month after, June 15, Robert files for bankruptcy. And a bank collector informs you that he can no longer pay for this debt. Okay, so that means we can no longer collect this. So this is a for sure deadbolt debt. Okay? So, what are we going to do now?
15 July.
So 15 of July.
Bankruptcy.
No,
Bad.
no, not bad debt yet. We're not at the end of the period.
Okay, so it's still the allowance for doubtful.
Yes, it will be allowance for doubtful accounts. And then where are we taking this money back out of now? Where are we transferring it from? Accounts receivable is correct. Okay. Again, why are we putting it in this pile? Because at the end of the year, or whenever the period is, in this case, we're just going to make the assumption that it is at the end of the year. We're going to recognize here that when we have our balance in our allowance for doubtful accounts, at least this is so we know where it came from. Okay, it's not just a random number that comes out of nowhere. This is from us doing business as usual, going through the day-to-day monthly statements and realizing that this person is for surely not going to pay us back. Okay, and from the continuation, we know that it should be 1032.67 because he was actually able to pay $50 out of it. Now that we have this actual statement right here, there is no way he can pay us. There is no way. If you file for bankruptcy, you pretty much you have to write this off. Okay?
Okay.
All right. So here goes the next scenario. On December 31st, your company estimates that $259. Okay, hold on. I should have made this a little higher because I realized I'm gonna make this. Okay, 2000. So I'm gonna make that typo. I'm gonna fix that. Okay, $2,590.54 is going out of the 29,000. Accounts receivable are uncollected, including Robert's debt. Okay. Actually, wait. No, I had it right the first time. I'm sorry. Let me go back. Okay. This is the number I'm supposed to fix right here. Okay. So, all right. Again, let's start again. So, for number 6, on December 31st, your company estimates that $259.54 of is $29,000 accounts receivable is uncollectible. Okay, you just made this estimated number that out of the 29,000, you're only gonna $300 is not gonna be collectible. So that's 1% difference right there. Okay, so including Robert's debt, you have a total of a credit balance of 1570.62 in your allowance for doubtful accounts. So, how do you solve for this?
First off, the date.
Yes. which is going to be December 31st. And then I just realized I made another mistake, but that's okay. Just go ahead and continue.
Okay,
First off, let's recognize which method are we using.
Balance.
We're using the balance sheet method. Okay? So first off, let's start off what are the three things you need to look for when you're doing the balance sheet method?
who?
No? No?
What? Dave?
No? So when we're doing the balance sheet method, there are three things you need to recognize. You need to recognize the estimated amount. You need to determine the word accounts receivable. And then from there, you need to recognize what is the balance in the allowance for doubtful accounts. So,
Balance is 1570.62.
okay, start with the estimate first.
You estimate 259.54 of 29,475.72 is uncollectible.
Okay. What's the second thing you need to recognize?
The words account receivable.
Good. Okay, and what's the third thing you need to recognize?
Total credit balance.
Nope, not total credit balance, David.
No, we don't care about that.
Right now, we already know that we're doing the balance sheet method. Why? Because you have the keyword accounts receivable. Right?
Okay. Accounts receivable tells you balance sheet.
Yes. Okay. Now, if we care about what's in our balance is in the allowance for doubtful accounts, what was the thing that I showed you? Okay, if we need help, okay, so one more. Okay, if you need help,
either add or subtract.
okay, how do you determine which one you're adding?
The estimated price and the 1570. The total cost.
That's not the total cost.
You add them together.
That's not the total cost. What is that? What is this 1570?
Total credit balance.
Not total. Okay, total credit balance in what?
Allowance for
In the
doubtful
allowance for doubtful accounts. Okay. Now,
Yeah.
by determining there is a credit balance, what do you do when you see the word credit balance?
We
Minus
subtract.
You need to subtract. And what number are you going to be subtracting?
259 and the 1570.
Correct. So, if you subtract those two numbers, what do you get?
Uh, 1311.06.
Okay. So 1106. Okay.
Where is he getting 06? Shouldn't it be 08?
08, let me see. 62. minus
I
4.
got 131108.
Okay.
Huh.
David, what number did you use?
1570.62 minus 259.54. I just did it again. I got 08.
Okay. So 131108. Okay. Now, what are the accounts that you need to recognize? We're at the end of the period, okay? We're assuming that December 31st, the key word here is the company's estimating something. Okay? So what are the accounts that you're going to be using?
A bad debt.
Bad debt, good.
And allowances for doubtful accounts.
Good. Okay, I don't have space.
I know. I just put BA, and then I was like, oh, what's that? What's that stand for?
Okay, so again, we recognize that because of this rule and this methodology, if we are using the balance sheet method, okay, whether you have a credit balance or a debit balance in the allowance for doubtful accounts, this is going to make up what you need to record for your bad debt, okay? Because allowance for doubtful accounts already has a credit balance. Therefore, if you've gone left, right, you don't need to go left anymore. You need to just make sure that you need to subtract the numbers instead of add them because you're already in the left side. Okay, I don't know if that makes any sense. Wait, left is debit, right is credit. So right, you're already on the right side. Okay, if you have a debit balance, that means you've gone left for however many points, right? And you're trying to get the total amount to end up to be this number. So therefore, you need to add the two numbers together because you need to calculate the amount to get to 0, and then you need to make sure that the account is up to the actual number, which is your estimated number. Your estimated number. Okay, so in this case, this is how it should be. Yes. In this case, we already have a large number in our credit balance, so therefore we need to subtract those two numbers, and you should get 131108. Okay. Okay. So the following problem are not related to problems 1 through 6. So let's go ahead and look at this. A company estimates that 20,000 of its 500,000 accounts receivable are uncollectible. There is currently a debit balance of $5,000 in the allowance for doubtful accounts. Journalize this entry.
Excuse me.
Okay.
Well, first would be the date, and you don't have that.
That's okay, but we're just assuming this is the end of the period, right? Because we're making an estimate already.
So it says accounts receivables. So we think the balance sheet, right?
I'm sorry, say that again?
Accounts receivable, we think the balance sheet.
Okay, good.
So we want
Good.
to take 20,000 and 5,000 minus 5,000.
What made you come to the conclusion that you need to minus this 5,000?
It's a
Hey, no,
debit,
no,
so you have
you
to
add.
add.
Yeah, you have to add 20,000, 5,000.
Okay, so what?
I just did read.
Okay. So again, what is the total that we are going to be journalizing?
25,000.
We're going to be journalizing 25,000. Yes. Because here we recognize that we have an estimated amount. but we currently have a debit balance, meaning we need to end our allowance for doubtful accounts with a credit balance. So therefore, we need to add these two numbers together to get a total of 25,000. And what is our journal entry going to be? What is the accounts?
Accounts receivable.
No. Bad debt, yes.
Bad debt.
Bad debt expense, okay? Remember, this is assuming we are at the end of the period. So at the end of the period, are we dealing with accounts receivable?
No, it's gonna be the.
It's going to be the bad debt expense, yes, and we're making
An allowance is the bad debt.
yes, and we're utilizing the balance sheet method, and therefore, because we're recognizing this at the end of the period, this is an adjustment entry. I'm gonna write DA. Okay, you guys understand what that means, right?
Yeah, that's what I've been doing.
Okay.
Yeah.
All right, good. Now scenario, okay, so question number 8. A company estimates that 20,000 of its 500 total credit sales is uncollectible, okay? There is currently a credit balance of $5,000. Let me make sure there's a,
So you do credit, you minus 2,000 and 5,000.
no. Why do we not do that? Let's read this again carefully. It is estimated that 20,000 of 500,000 total credit sales is uncollectible. Okay? There is currently a credit balance of $5,000 in the allowance for doubtful accounts. Journalize this adjustment entry. Or the adjustment entry will be
See the word is total credit,
okay.
and so it'd be 2,000 even.
2,000 or 20, what is it?
20.
Or well, 20,000. You know, I forgot to say.
Okay. Yes. Because what method are we dealing with when we're looking at this total credit sales?
The not the first one, but the second one.
Income.
Income statement.
Yes, we're dealing with the income statement, right? And the income statement does not have accounts receivable or allowance for doubtful accounts on it. Okay, so therefore we're going to recognize bad debt expense and what was it? The allowance for DA. Okay, doubtful A. Okay, for the amount of 20,000. Okay. All right. Question number 9. A company estimates that $20,000 of its 500,000 total credit sales is uncollectible. There is currently a debit balance of $5,000 in its allowance for doubtful accounts. The adjustment entry will be
I want to say $20,000 because you see full credit.
good. Yes. Bad debt expense and
You're just testing me, weren't you?
this is the example. Allowance for doubtful doubt A for 20,000. Yes, that is correct. What method are we using? Income statement. Yes. Okay. I think this is the last problem here. A company estimates that 20,000 of its 500,000 accounts receivable are Okay, it's supposed to be is uncollectible. Okay, there is currently a credit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
The method is balance statement,
okay.
or and so I want to see accounts receivable.
Okay.
I want to credit balance is negative, so I want to minus 5,000 to 20,000.
Okay, so what is the total?
Is my thinking correct?
Yes, so what is the total number now?
Oh, 15.
15,000. Yes, good. We're doing the balance sheet method. We recognize the estimate here. We see the word accounts receivable, and we recognize that if it's a debit, we add. If it's a credit, we subtract. So here we subtract $5,000 from $20,000, and we're gonna get a total of $15,000. Okay, for $15,000. Okay, good. Is everyone okay with this? Is it kind of easy to understand? If not, then I can spend another day to go ahead and give you more examples of this.
I think it's like everything else, practice for a while.